tonight's the last class of our three-part series in building your trading foundations. Now, we're not going to go back and revisit what we've already learned. We've learned the different types of charts. We've learned what trends and trend lines are. And now we're ready to put our next line on our chart. So support and resistance is one of the most widely used concepts in trading. Strangely enough, everyone seems to have their own idea on how you should measure support and resistance. Now, support and resistance, and it's a lot to say, and we'll say it a lot, support and resistance. Sometimes I call them price levels, price zones, but I explain them as if you're in an elevator, okay, the floor below your feet is your support level. The ceiling above your head is your resistance level. As you move up that elevator, you need to jump through or break through this resistance level to reach the next floor. When you reach that next floor, you have a new ceiling above your head, and your resistance now becomes your support. Now, when the elevator starts moving down, it's just the exact opposite, because you have to break through the floor below your feet. So that is now your resistance again, because you're jumping as hard as you can to break through that floor. And when you do that, you come down to this floor and want to break through, your support is above your head. So every time, imagine you're jumping up and down, up and down, up and down. You've got to jump through, when the elevator's coming down, through this level to keep on going down. So as you're bouncing up and down, imagine a ball bouncing up, it's going to hit that roof and come back down and come back up, and will eventually break that floor. So I always imagine them, or say, just think of them as the floor below your feet and the ceiling above your head, and which way an elevator is moving. And then you can figure it out. But really, the words are interchangeable. Okay, that's why sometimes I just like to call them price levels or price alert or zonal or alert zones, because when price is moving up, we realize it's got to move through that ceiling. When price is moving down, we realize it's got to go through that floor. Now, you may have heard the old cliche, buy low and sell high. Forex traders usually ask the question, how low is low and how high is high? One way we can quantify these levels is using areas where price has stopped and either changed direction before or hemmed and hawed. It is where something significant happened with the price. Not today, not yesterday. It could have been last year. It could have been 2 years ago. Like we know when gold's moving up, okay, right now, every time gold moves up, 1,500 is a tough level, gets above 1,500, we know 1,600 is a good tough level, because those are psychological support and resistance. But we also might realize that every time gold is, last year hit 1,560, it hemmed and hawed there and it stayed there, and then eventually fell off of there and eased back down. So we can say that we know as gold's breaking the $1,500 level and moving up, it's going to have a problem at 1,560. It doesn't mean it can't go right through there, just like the elevator. It can skip floors and go all the way up to the roof. But you need to know where these floors are, that it might stop. Now, think about this. If you knew that an elevator was moving up, from floor to floor, up and up and up and up, and floor to floor, floor to floor, in a medium-rise building, okay? Well, if you evaluated that building, so say it's an office building, and so you just got there, you went there 10 times last week at different times of the day, and rode the elevator. Okay. Now, you also assessed the environment. You realize on the 10th floor of that building is a very well-known restaurant, but it's only open lunchtime, and everybody around town is in the other office buildings comes there for lunch. You also find out that on the 19th floor, that's the roof deck, and it's a smoking deck. It's got a little lunchroom for the employees who work throughout the building, and it's got vending machines, and it's got a big, beautiful balcony where people can sit outside and smoke. So those two pieces of information are very important. because you know statistically, if the elevator is moving up from the ground and it's 1 o'clock, there's a good chance it's going to stop at 10 because people are going to get on that elevator, are going to get off that elevator, go to the restaurant. If it moves past 10 and it's got people in there, there's a good chance it's going to make it to 19 because it's full of smokers. Now, if you go back and evaluate, it's 9 o'clock in the morning and all the workers are coming to work. And the buildings, you know, some retail on the ground level, you know, next floor, and the next 10 floors or the next 19 floors are all offices and, you know, stuff like that. So in the morning, you know, 8:30, 9, 9:30, 10, people are coming to work. So the elevator's most likely to stop on all the floors. But it's probably not going to stop that often on 10 because the restaurant's not open, and the people going to come in to set up for lunch and stuff aren't going to come in until a little bit later. But you know, also, it's going to have a lot of trips up to that roof deck because there's coffee machines up there, there's smoking areas, there's vending machines. So lots of those employees are coming to work who want their morning coffee. They're either going to come down and go to Starbucks, or they're going to go up and get it from the vending machine, or they're going to have their morning cigarette. So what have you done? You've analyzed the floors below your feet and the ceiling above your head and how that elevator might move or how price might move. And you've made evaluations that can help you figure out what is going to happen in the markets. Now, one thing to remember as opposed to an elevator and a floor is support and resistance levels are not exact numbers. That's why I use level or zones. Okay, because you're not going to say that we know that the euro always gets stuck at 110.9742. Just impossible. So we're going to say we know the euro always has problems at 110.97. And it might be 110.98 that it had trouble with last year, and one stopped often, and 110.97 this year. Okay, because support and resistance lines are not just based on where price is. It's based on where price is today, but the zones and the lines come from historic action. So support and resistance is common jargon for areas on a chart where prices had a difficult time breaking through. Support levels tend to stop price from falling below a specific point, and resistance levels act like a price ceiling that price cannot break above. Knowing where these levels are make it much easier to decide when to open and close trades, and how can we locate these prices? Well, there's many ways that we determine support and resistance. And this is a personal choice. And you can use many of them. Okay, I use what I call eyeballing. I believe it's the best method possible. And it makes you interact with price and makes you more knowledgeable. And it also makes these lines customized to you. And eyeballing means going back over charts back last week, last month, last year, and reviewing when price is traded at this range. Because the only important levels, even though we know the elevator goes up to 19, it goes down to 0, the only important levels are around where the elevator sits right now. Okay, if the elevator is moving up and it's already at 8, we don't care much about 7 when we're going up. So, but we do in an overall understanding, because once we've evaluated these support and resistance, they are good for a long time, not days and weeks, but months and years. So I believe eyeballing is the best way to get that. And I'm going to show you a little presentation in a minute how to get it. But another way to get short-term support and resistance is by isolating swing highs and swing lows. As prices moved up and down, the highest price it was able to get in a swing high, and the lowest price it was able to attain in a swing low. So another great way to find support and resistance levels is to mark the levels in the past where price had a difficult time breaking through. As price moves up and down, each level that price has bounced off of could be a level in the future that price bounces off again. Okay. Now we're going to go through all this in great detail. But one of the other ways, I'm just going to jump through a couple of the other ways, is using what we call pivot points. Pivot points are mathematical calculations, and you can get them from using a pivot point calculator or by going to one of the big technical indicator websites like investing.com, Forex Factory, FX Street, which will already have them calculated for you. But they're constantly changing based on high, low, close, but they're only mathematical calculations. So what you see is off of a pivot point chart. Okay, and it'll give you the 3 levels above and the 3 levels below the current price. Okay. But because they're mathematics, there's nothing really involved in them, and they're not so, to me, reliable. I don't use them at all. Lots of people do. I don't use them at all. But also, when you're using a charting system and you see that it'll automatically put on support and resistance levels for you, what it's doing is putting on support and resistance based on pivot points. Now, remember, markets ebb and flow. They go up, they come down, and they move sideways. The primary way we make sense of this movement are analyzing price action, as well as the levels in the market where price bounced higher or rotated lower. And we call these levels support and resistance. So we can use a trend line, or we could call a trend line a support line or a resistance line, because price should respect that trend line. So when price is moving up, if it declines, it should bounce off that trend line and bounce higher. So we have trend lines. We also have moving averages. Now, moving averages are constantly recalculating, but price above a moving average is being supported. Price below a moving average is coming through resistance. Now, support and resistance levels form the foundations for technical analysis that help us build a framework from which we can understand market price. For price action traders, support and resistance levels help us plan our stop loss placement, our profit targets, and perhaps more importantly, the levels that give us a way to make sense of the market in terms of what it has done, what it is doing, and where it might go next. So I mentioned we had dynamic support and resistance, which comes off of moving averages and pivot point charts. And then we have static support and resistance, which comes off of support and resistance lines. So here is an example on this screen of support and resistance, or what we call dynamic, based on a moving average. And see, the blue line is the moving average. Then we have things like retracement levels. We get them off of Fibonacci tools. These can be used as support and resistance levels. I don't use Fibonacci's. Now, 50% retracement is really not a fib number. It comes from Dow theory. But we could, when we see an uptrend, calculate the 50% and draw a line through our charts and say that is our support or resistance level, as you see here in this chart. But like I said, eyeballing is my favorite and the best way to do this. So let me pop up a live chart and I'll explain to you eyeballing in detail, and then I'm going to share with you a presentation. What you're looking at, and when it's there you go, is my Euro US dollar teaching chart. Not recommending the Euro US dollar. Now see all these lines on this chart? These are lines that over time I have drawn on the price chart. These are particular areas where price in the past, and when we look at this, this is right here. Well, hold on a second, let me get my marker off here. Okay, this is from November 19th of last year. Okay. We can see how important that level was. Then if we drew the line forward, look at all the prices that we got touching that line that couldn't break through. Then we have all these closes. Then moving forward to December, we have all of these closes. Then moving forward to right now. So these lines were drawn way back in the past. When you see, I color code my lines. This is just my preference. You don't have to do this. A red line tells me that I've drawn these on over a year ago. When the asset was trading in this price range a year ago, but I didn't know where it would be in this price range now. Once you draw them on your charts, they extend forward into the future. And whenever price is around that level, they become valid again. So we're looking right now at a 4-hour chart. And you can see all of these lines that I have drawn on here. And this is from old charts and old times and extended forward. When I drop this down and look at my more current chart, most of those lines are gone because they didn't go anywhere, but they're not around where price is today. Now, these two red lines were extended forward, and these two were extended from a year ago and from that longer chart and extended forward to today's trading. And look at this, as price fell back into this range, look how critically important this level was. When it made this huge down move here, where'd it come? It came to this level. Sure, it fell below there, but it came right back up. And then look, it's been bouncing up and down since yesterday, or for the last couple of days. It has respected that price. When it bounced up, look at where this high came to. It came right under that resistance level from way back when. Now, you can have lots of support and resistance levels on your charts because this is a range from 110.08 to 111. We could have say, okay, we need to isolate some more ranges in here, and we could go back to it. We can just simply change the time frame of this chart. We can go back to a 1-day chart and then try to find something in this level that was more important. But you see all of these lines in July of, then these red lines here were extended from before January of 2019. Now, we might look back here and see, okay, we want to tighten down a range here. So we can see what we're looking for is where we had a significant price action. And we're not just looking for one group, but we're looking within a price zone. So if we can extend this forward here, this, and this is when price was trading here back in May and June. Price moved all the way up here to August. And okay, so those levels became significant at two different trading times. So we can go on our chart and put on here a horizontal line right there. Let's make these so we can see them easier and differentiate them. We're going to make them blue, the ones we put on here right now. And let's put a second line on here. Now, we can see that recently it's had some relationship with this price level. Several months ago, that price level was important. Way back here, that price level was important. Okay. Now look, as price was coming down here, and remember, we're looking at a 1-day chart. So this is February of 2019. That's a year ago. So as price was declining, where'd it come to? It came to that level and bounced off, moved up to that level, came back down to this level, bounced up, moved back up. Now it went right through. But look at this, my older price level held, then it bounced up, and then it came down, and I got stuck right here again. It fell down to this level and then came back to this one and it held again. Okay, so we know that these prices have some type of importance to traders in the past. There is no law. There's no rule. You decide where you're going to put these lines. Okay? You want to standardize how you do them, and I do. I know exactly from doing this for many, many years. My eyes know exactly what I'm looking for. But it's not like drawing a trend line that has lots of rules about it. There are no rules. This is where you can personalize how you do it. But it doesn't mean that you jump from this way today and that way tomorrow, and then you want to make this one work. No. What I'm saying is you build your own personalized decision-making on how you're going to draw your line. And then after time, you'll see that your eye just sees them the same way all the time. So now let's move this chart back to our 1 hour chart. And see, now we've got these two blue lines, which are isolated and current on our charts, but they still don't help us in this range because it hasn't really been in this range in quite some time. So we're going to go back here just to earlier this week and see what level was also important. So we can see here that that price, let's change this to a different color. Was important here, important here, important here, important here, important here. So going forward, because we're not concerned with what happened yesterday or tomorrow, we drew these lines because we can only use it for our trading moving forward. So as we pull our chart forward, okay, look at that brown line that we put on there. Look how it jumped up, hit that as a high, came back down, held at our red line, moved back to that brown line and held, came back to our red zone and held there. Now it's fallen again, so we would have to draw lines lower. And it's moving down. We have a line here, an old historic line at 110.03. We don't have much in between we can look at because the price hasn't been there for quite some time. So we would have to be lost 110.03 level because that's, you remember, that's a very, very low price euro. It did fall to 108 a while back, but it's telling us the euro is very low. So we've now got all of these lines on our charts. And in order to get something important, but we don't have to, as you can see, we don't have a low anywhere near. So if I go back and again, look at my 1 day chart and try to find something, I really don't have much, because look at it. It only peaked down to that level once a long time ago. Let's see, coming back up here. And it's only been at this price level once. And this is all the way back, June of 19. Let's go back a little bit farther. Let's take a look at a 1 week chart and see if we can see anything. Not really. See, that's the problem, is the euro is traded so little at that level that once we have to go back way, way far, going back 2, 3, 4 years ago, whether that price is going to have any validity today is hard to say. So let's move it back into the current reality. And so this is where we stand at the moment. With our next support zone is at 10.30. Okay. This is the best we can do. But when price falls down here, we would hope that it would bounce off of and come back down. But we still have to isolate lower zones because without having them, we won't be able to use. But if price bounces back up, we know it's going to hit this 110.08 and have some type of reaction. It might move up to that 110.93, and it might move up to the 111. Okay, so this is how you put your support and resistance lines on your chart. And this is done by, like I said, as eyeballing. And since we're really desperate, we can look and see where. This is where price was just earlier today. I mean, no, a couple days ago. So we could use this. Level right about there. And I'm going to go define that. And I'm going to make that purple. But I'm also going to change it to a dashed line, because I need to remember that this is a short-term line. This is not something that was really good that we could bring back from the past. This is only, so by color coding it, I know what I'm telling myself. Because as price moves, we're going to see it come around here. We're going to know that's a short-term current trend line. We know these red ones have been supported historically over quite some time. We know the brown one comes back. It's more recent, but it still goes back with significant control. We know we just put the blue ones on here. Now, once you've got these lines on a chart, you don't have to keep adding them, because as price moves back up to this level, all of these lines become useful again. When price falls down from that, all of these lines. So the lines stay and keep moving forward into the future. So technically, you could have a chart with this. With a zillion lines on it into the future. And those are all valid. And that's one reason I color code them. Now, one of the drawbacks we have with TradingView or all charts is you might accidentally pull these up. Now, TradingView is really nice. If I don't click on save, when I go bring it back up, it'll bring back my old one. But they also have a lock button, so you don't accidentally pull these lines in the wrong place. But that's always a problem that you should be aware of. So now we've got all of these lines on our charts. So let's go back to our PowerPoint and figure out what we're going to do with them. So now that you know the basics, it's time to apply these basics but extremely useful technical tools to your trading. We want to make some things easy to understand. We divide how to trade support and resistance levels into two simple ideas. These are just two basic ones. My firm belief is that every chart, and I do this every day, the first thing I do is I look at my support and resistance levels, but every chart that you have for every asset you trade should have current support and resistance and a current trend line. These are and they should have volume. These are the beginning things, no matter what strategy, no matter what decision, should always be on your charts, because these are the basic tools. It's like, no matter what you're going to go fix or repair, you're going to bring your toolkit, and there's always going to be a hammer. There's always going to be a screwdriver. No matter what you're going to do, you should always have those two things in your toolbox, because eventually you're probably going to need them. So a hammer, a screwdriver, and a wrench. Most time you can get along with just those things. Now, one of the simple ways and a strategy that some people use that works actually quite well is trading support and resistance. There's the bounce. And as the name suggests, one method of trading support and resistance levels is right after the bounce. When price comes down or goes up and hits one of these major levels and respects it, bounces off of it, okay, you can trade that. It's called bounce, trading the bounce. Now, many retail traders make the error of setting their orders directly on the support and resistance level and just waiting for their trade to materialize. That's a big mistake. Sure, this may work at times, but this kind of trading method assumes that support and resistance will hold without price actually getting there yet. Okay. You might be thinking, why don't I just set entry orders right on the line? Well, keep in mind, number one, the line is not a finite line. It's a zone. Okay, so you don't have, number one, a definitive price, because you might have put it 1 pip too high or 1 pip too low. So when playing the bounce, we want to tilt the odds in our favor and find some sort of confirmation that the support or resistance will hold. Because, like I said, all these levels exist from just prior historical action. Doesn't mean the price can't just sail right through them without even stopping, or the price will go below them before bouncing up. So I call them alert zones. In fact, before we go on, I'll show you on one of my charts actually what I've done before. Okay. See, I've drawn zones where I've isolated two close prices and draw it yellow and filled it in. And this is what I call my support or my resistance zones. Because you can't have, I mean, you want them very, very close, but you can't define them so specifically that you can't make, that you're trying to lock in an exact number, especially in Forex, where you're using pips 4 digits to the right. So the best way to play this is to wait till price bounces off of that support zone and moves back up to set an entry order. And you would put your stop loss a few pips, depending on volatility in the asset, a few points below that support line, and you'd enter a few points above, but you'd have to wait for the bounce, and that's why it's called the bounce. You would not place your order while it's coming down here, or you would not place your order here. You will actually wait till it hits that support and bounces off of it, just a few pips, so that you know it's going in the right direction. So if you've been looking to go short, you might want to wait for a bounce off resistance before entering. Same thing upside down. By doing this, you avoid the moments where price moves fast and breaks through the support or resistance levels. From experiencing, catching a falling knife when trading Forex can get you really bloody. So in the perfect world, support and resistance levels would hold forever, McDonald's would be healthy, and we'd all be traveling around on jetpacks. In a perfect Forex world, we could just jump in and out whenever price hits a major support or resistance level and earn loads of money. The fact of the matter is these levels break and break quite often. So it's not going just enough to go just play the bounces. You should also know what to do whenever support and resistance levels give way. And that's trading the break. And the break is when price moves through a support or resistance zone. So the simplest way to play breakouts is to buy or sell whenever price passes, and here's the key word, convincingly through a support or resistance zone. And the key word here is convincing, because we can only want to enter when price passes through a significant support or resistance level with ease. One of the best ways to determine that is watch volume. We want the support in an area and the resistance areas to act as if it was just karate chop. We want it to wilt over in pain as price breaks right through it. And then we have the conservative way, which is a better off way for us trading, is to wait till price soars right through that level of resistance, and it's going to eventually bounce back up to it. Traders are going to try to push it back up. When it is convincingly bounces off of it again, or it can't make it through, then you would put your entry just a few pips below the support line, put your stop loss above, and trade that down position. Okay, it's just the reverse on the other side. This is a conservative way. Okay, it'll get you less trades, but it'll get you more successful trades. So if your choice is the second one, then you will easily understand that this type of trading Forex method. Remember, whenever you close out a position, you take the opposite side of the trade. So we've gone over major types of support and resistance and how I use them as indicators of market conditions, levels to look to buy and sell from, levels to define risk. When you combine a solid understanding of support and resistance levels with price action and market trends, you have the triumvirate of trading. Now I'm going to share with you a little presentation, and it's got no voice, so you just watch what the screen say and watch the text that I put on the screens. And it's going to show you a great little way to trade support and resistance. And it's just a very, very simple strategy. So it's just a PowerPoint presentation I put together for you. So watch, and below the chart, you see step 1, step 2, step 3, step 4. So as you can see, support and resistance doesn't have to be confusing. We can mix and match any of the methods above and create a healthy amount of price levels that we can trade. As always, practice makes perfect. So make sure to test out these methods using a real-time demo account, which you have with ETX. And once you've got it down pat, but make sure whether you're trading from support and resistance or using it for information on your chart, figure out how you're going to use it, what you're going to do, how you're going to draw them on, and create your own unique method of trading. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us, and thank you for being part of ETX. Good night now.